Afternoon and good evening wherever in the world you are. Welcome to the third episode of Palmetto Property Talk. And today we're going to be talking about what is a mortgage. This is going to be a multi-part series, so there's a lot that we're going to have to talk about. But we're going to cover a little bit of the basics today. So, Walker, what do you have to say?
Mortgages are fun. Everybody loves looking at numbers and talking about financial issues.
Yes, I think it's a riveting topic, but that's why we're here. So
make it a little more digestible. Break it up a little bit.
For sure. Well, all right, guys. Boom. So fun stuff. We're going to talk about a few of these topics. These are just four of the big terms that are out there. So a mortgage payment is just like any loan. So with a loan, you have a principal, which is going to be the amount that gets paid to the, well, it depends on if you're talking about a payment or if you're talking about the entire principal for the loan. So I'll give you a quick example. So I have $1,000 loan, okay? The principal is $1,000. So when I make a payment, let's say the interest rate is 3%, I'm making a payment that is 3% amortized. Let's say it's a 1-year loan. So 1 month, I'm paying 3% interest on that $1,000 balance. So interest goes towards, or part of the payment goes towards the interest, and part of it goes towards the principal, or the entire principal for the loan. All right, as it says, the amount borrowed to buy the home. Then just to make sure we're in line, the interest is the cost of borrowing the principal expressed as a percentage. So that's why you talk about mortgage rates. So 5%, that would be nice, but more so like 6.5% right now. That's what interest is. Then we talk about escrow, which is the account where a portion of your monthly payments is held in order to pay property taxes, insurance, and in some cases, homeowners association dues. So I would say the big thing with that, when we talk about this is talking about your monthly payment, right? And then you also have the one fun thing that most people have on their house and for their mortgage is a PMI payment, private mortgage insurance. We're going to talk about some options of how to avoid private mortgage insurance and also explain what I was talking about with principal, interest, escrow, and all of these other fun things with some examples. So Walker,
For those who don't know, what is private mortgage insurance? What's the purpose of it? And, why do I need to have this on my loan?
Yeah, so private mortgage insurance is put in place. You can either, the client can have it put in place when they apply for the loan, or a lender can put private mortgage insurance, a lot more expensive. But the reason why that is on there is if you have below 80% equity, so if you have, or not 80% equity, if you have not put down 20% or more down payment on the house, right, it's looked at as a risk. So to avoid what happened in 2008 and during that financial crisis, they've put private mortgage insurance in order for buyers to be able to buy a house with as little as 3% down.
Right.
So it's more so a coverage for the loan, but also a coverage for the buyer.
Right.
So yeah, it's not everybody likes to do it, but at the end of the day, that's what happened in 2008.
Right.
Even though private mortgage insurance has been around longer than that, it is something that has helped prevent more catastrophes from happening.
People defaulting, not being able to afford their loans.
Exactly.
Those subprime mortgages, that little buzzword.
Well, you can still do subprime mortgages. It just depends on what you're talking about. If we're talking about predatory lending too, there are subprime mortgages. They may require a very expensive PMI payment, so they do exist still. So, yeah.
Fun stuff.
Yeah, private mortgage insurance has been around since the 70s, I believe. The first, I'm trying to remember, it was either an act or it was, there's a few that I worked with when I worked at a bank, and they're really great companies. They do look out for the client, but because they allow you to be able to buy a house with as little as 3% down which is crazy because if you're buying a house that's worth $400,000, you're only putting $12,000 down. In the past, you might have had to put 5% down. It depended on the laws at the time.
Right.
So, yeah, so definitely a great option. All right, so now the meat and potatoes. Like I said, we're going to go through a quick example. I know it's riveting information, guys. But
bunch of numbers.
It's important to know. It's important to know. So many people don't understand what their payment is actually paying. All right. So, scenario. I have a $250,000 mortgage with a 5% rate. Would love to have that for a 30-year term. So then my monthly and principal, my monthly principal and interest payments total out to be $1,342.05. So what does that mean? So let's go back to that real quick. And the interest. So if you're looking at it, the interest is the majority of that payment. The reason why that is, do you know the reason?
Because the interest is paid much more heavily up front in comparison to the back end of the loan. Because you spread out the interest and you front load it and then you back load the principal.
Well, yeah, it's that, and you haven't made a payment towards the principal yet.
Right.
So you're right. So we're paying over $1,000 in interest, and we're only paying $338 towards the principal. And then my remaining balance after that is, very little difference, but you are making a payment. So that's really when you look at what we were just looking at, that's when a mortgage loan officer tells you, hey, this is what the payment is. They should be telling you this is the P&I, or principal and interest payment. PITIA, principal, interest, taxes, insurance, and association dues, which would be HOA. That would be the more accurate number that you can expect, right?
Right.
Because if I only tell you the principal and interest number,
you're not getting the full cost of ownership per month.
Well, exactly. Yeah. If you don't have that, then I'm not telling you the whole truth.
Right.
Because I believe here in South Carolina, it's required by law on a principal or primary residence, you have to escrow everything.
Right.
So yeah, it's required, and that's why it's important for you guys to ask questions. How much am I paying in HOA fees when I'm looking for a house? How much am I paying for taxes each year? And then how much am I paying for hazard insurance? So,
right.
Yeah, that makes a huge difference. We're going to talk about more of those topics later in another episode. All right.
Your mortgage types.
Dude, I feel like I'm talking way too much, but
no, it's good.
Here we go.
We front loaded your half.
This is true. Okay, so these are the big ones, and there's so much more to be talked about in these because this is wave tops. We're not talking details. I wish we had more time to talk about each and every program, but I'm going to give wave tops. Okay, so 30-year conventional. You'll say Fannie Mae, Freddie Mac. Okay, so that is going to be the most common loan that's out there. It's going to have requirement of 3% down. There's going to be PMI if you do 3% down. With that being said, there's going to be a higher credit requirement for a conventional loan. And overall, I mean, it's just the most common. The rates are a little bit higher than a government loan, but they're what most people go for.
Who would you say that 30-year conventional is for?
Well, I would say really it depends. When I talk about 30-year conventional on here, there's a ton of programs that include that because FHA is a 30-year fixed, but a 30-year conventional, you have affordables programs that can work for clients who make below, a 80% or lower of the median household income in an area. But I would say it's really the average person. But it really depends though, man. I think the Fannie Mae, Freddie Mac 30-year conventional, there's no one really, I mean, there are people who can be excluded from that if they have low credit scores and other issues of down payment.
Right.
But really it's the most common. I wouldn't say there's one bucket of people that I can
That it's
say.
for. That is your default option.
Yeah, it's the most common. It's what everybody, when they're asking about a mortgage, that's what they're thinking about. But I mean, there's a ton of different programs out there that include this conventional 30-year. I guess if we were going to sum it up, I would say, a first-time home buyer could fit in that, but a first-time home buyer could fit into most of these.
Right.
So, yeah. So then we've got FHA. FHA, do you know what that stands for?
Federal housing something, right?
Administration.
Federal Housing Administration loan.
Yeah.
That's right.
Yeah. So the FHA, it is a government-insured loan. It's not guaranteed, right? A VA loan is a government loan that's guaranteed by the Veterans Affairs. So that's actually why there's a big difference. But the rates are usually very similar.
Right.
Because it's a government-backed loan, it actually has a lower rate. But with the FHA loan, you have to put 3.5% down, and then you have mortgage insurance the entire time. It's mortgage insurance premium. It's not PMI. It's MIP.
Right.
You have to pay an initial upfront mortgage insurance premium that you can finance into your loan. But also, you're paying a larger down payment, and you're paying mortgage insurance the entire length of the loan unless you refinance it.
So this one doesn't have the option to get rid of that insurance.
No, it doesn't.
Whereas a conventional would.
Yeah, so you don't have the option. You're trading off, right? So you have some limiting factors of how you can use the FHA loan. You can only use it on primary residences, and also you cannot use it over a certain amount. So the loan size is limited. There's no income qualified, like you can't make over a certain amount and then you're not qualified, but you can only buy to a certain size of loan. I think it's like $545,000 here in Charleston.
Right.
Which I mean, by is a pretty nice house, but it's geographically limited in its price or volume.
Right.
But I would say the FHA is great for first-time home buyers. You do have to bear in mind the pros and the cons. I'm paying mortgage insurance the entire length of the loan, and I'm paying, I think it's 1.25 or 1.15%. I'll have to double check on the numbers. Correct me if I'm wrong in the comments. I need to know how to do my job better. So the mortgage insurance premium that you pay up front, that can be significant. If you're financing it, that's cool, but that could also affect what you can qualify for.
Right.
So that being said, the pros is the lower rate, and the cons, I would say, is really the mortgage insurance the entire time, and then also the
price limitation.
The price limitation. There's three. Yeah, price limitation, and then the mortgage insurance premium you have to pay up front, which makes a big difference.
Especially in your closing costs, which we will get to later down the line.
Yes. Just like one we're working on now. So we've got VA loans. So crazy. I put a little graphic there with American flag and some keys. VA loan, Veterans Affairs, or Veterans Administration, my bad. So Veterans Administration, it is a loan that is guaranteed by the government. Once again, great rates.
Right.
I would say there's not very many cons in my opinion. You get up to 100% financing, so that means 0% down the entire time of the loan, which is nice. You can avoid, there's a funding fee. So a veteran will know when they get a certificate of eligibility if they qualify to not have to pay that.
Right.
And that's usually if you're disabled. So that's how that works. But you can get a house with a VA loan if you're working with a really great seller.
Right.
You could buy a house with nothing other than like the credit application and an appraisal.
Right.
So that's insane. Obviously, it's for veterans or active duty service members.
Right.
So what questions do you have about VA loans, I guess?
So you mentioned having that initial, would you call it an origination fee?
It's a funding fee.
Funding fee.
Mm-hmm.
That funding fee. What level of disability do you have to qualify for? Because I know some people have more disability than others.
Yeah, I think the big thing is you have to really look at your own individual letter of eligibility in order to see that. I think it is a case-by-case scenario. I think traditionally, and some people may have this already, I think if you have a 50% disability rating and higher, you don't have to. But I think, there are people who have it as low as like 20 and 30% who have had it.
Right.
Been able to not have to pay that. But like I said, it's really case by case. But I don't think there's an exact number.
There's not a written threshold.
I think the big thing is, and this is the most important thing, is those guidelines do change, and I just need to double check. But to my knowledge, there's not a set number. But I would say traditionally, in my experience, if you have about 50% or more disability, you can qualify to not have to pay that funding fee.
Right.
Yeah.
And is that something that as a loan officer you can work with the client or the person, the borrower, and help them get that, help them negotiate that, or is that more of a rubber stamped?
So exactly. So like, I can't do anything with that. I might be able to connect them with resources as a veteran to say, hey, this organization or these people helped me get my disability rating, risen higher, and that may result in that.
Right.
But there's not something I can just say like, hey, let me call the VA. I'll tell you if you're a veteran, that the VA sucks. When you try and call them on like a 1-800 number, you're going to be on hold for an hour, but if not more. So. Right. Yeah, I would say I can connect them with resources, but I can't do anything to change that for them.
Right.
That would be great, but no.
Good old fantasy land.
Yes.
Now, all right. USDA loans. I know these are fun for a lot of people.
Yeah, I actually have never originated one, and don't know as much about USDA as much as the other three, but I do know that the USDA, you can qualify for up to 100% financing as well, which is really great. There is a lot more restriction with how, there's not really a restriction with the price, but more so with the debt to income piece. And that's a big one. This is also a big one. People calling me. So anyways, the USDA is really specifically for rural area development. And what that means is, if I'm in a certain zip code, if we're here in Charleston, let's say you want to qualify for a USDA loan, where do you think would be an area that might qualify?
You're looking probably a little further out, maybe on McClellanville. You're probably also looking very much outskirts of Somerville in some respects. Pretty much anywhere where you have big open land is the main thing. Yeah, so
that is true. I think the big thing is you have to look at zoning, and you have to see if the property does fit within the criteria. So that's something that you can look into on your own. But the USDA is for rural area development. So what that means is if I'm moving to the outskirts or to a very rural area, and in Charleston, like you said, on McClellanville, say I wanted to move out to Ravenel or Hugie or even Ladson, Ridgeville, those kind of areas, there are properties that would qualify for that.
Right.
And the other thing is it can't be a working farm. It could have farm aspects. So let's say I have a farmhouse that I'm buying, and there's acreage,
a barn on it.
Acreage, and I can grow crops if I wanted to, but it can't currently be producing crops, right?
Right.
When I purchase. So yeah, that's the USDA program is a great program. I need to learn more about it. It's not really our wheelhouse.
Right.
We don't really travel out those ways as much, but they still do exist.
Right.
So
some of our less common loans, rehab loans and arms.
Yes, I love the picture of the arm. It's very, very handsome. It's not even mine. It'd be even more handsome that way. Anyways, so Walker, what do you think an FHA rehab loan is?
So I know we've talked about this, especially in past episodes. You know, FHA rehab really is for people who want to buy a fixer-upper. They want to buy a home that's a little bit cheaper, and then also include in the financing the renovations.
Yeah, so I think that's spot on. You know, the FHA allows you to be able to purchase a home that has, you know, some needs that need to be fixed before you can move in, and you can actually put that with the financing of the property. You can finance the improvement of the property.
Right.
So yeah, it's a great option. And the other thing is it is interest only for 12 months, and then on the 13th month, if it's not completed or the renovations are not completed on the 13th month, it would still be interest only. But then after that, you know, it would be principal and interest. So it gives you about over a year to get all of the improvements done,
right,
which is really, you know, very flexible. So yeah, no, it's a great program. I wish more people would take advantage of it. I think more and more people are hearing about it on, you know, Instagram, TikTok, and YouTube, you know, because it is something you kind of house hack, and this could qualify for even duplexes.
Right.
So it could be a real win. All right, then ARMs, adjustable rate mortgages. Not my arm. That would be really weird. I'm not selling my arm for a mortgage. Might be worth that much, but I don't know.
Maybe to some cartel.
I hope not. Jeez. So an adjustable rate mortgage is exactly what it says. So the rate adjusts. We can talk about all of the intricacies of an ARM in another episode, but really you might be able to get a lower rate with an ARM. Right now, the market is not, there's no appetite for ARMs. That is somewhat changing, but they're not really happening right now. They were being produced a lot during COVID, you know, but in a high rate environment until things change,
right,
it's going to be, you know, hard to really produce ARMs as much as they were, but they can be great. They can usually offer a great rate. And I would say the benefit is if you plan to live somewhere maybe 5 to 7 years, you know, do an ARM, you know, do an adjustable
right,
rate mortgage. And if you plan to leave and sell within that time period, then it works.
Right.
But, you know, there's a lot more to be aware of because, you know, the rates change. So let's say I have a 5-1 ARM. My rate stays the same for 5 years, and then it adjusts. And that can be very scary for some people.
Right.
And it can put them in a very, very bad situation.
And you can refinance out of that ARM if it's not going to work for you.
Yeah, so you can refinance out of an ARM into a fixed rate loan. There are other options. You know, there's actually loans that have options where you can do an ARM, you could do interest only, you know, switch it to a fixed rate. They're not as common as they used to be, but the ARMs are, like I said, they're not common right this second, but when rates do come down, we'll see what happens. But I think they'll definitely make a comeback here soon.
Right.
So
more of a low rate environment product.
Yes, for sure. All right, so now we can actually let you talk more.
I know. The mortgage impact. You know, I like to say that, you know, that mortgage really does affect what you can buy, where you can buy. You know, as we were just talking about, there's certain home value restrictions on, you know, FHA loans, for example. USDA loans have geographical restrictions.
Yep.
You know, so, you know, and the condition matters. And, you know, we were just talking about those FHA rehab loans. And are there any condition requirements for any of the other types of loans that you can think of? So
yeah, that's a good point. You know, just go back real quick and look at it. I would say, you know, with the government loans, FHA, VA, and USDA, but specifically FHA and VA, they're a lot more stringent with appraisals. So there is a bit more requirements of things that need to be repaired because they have to be met to a certain standard. Because a conventional loan, you might have a home that is being sold as is, that's kind of hard. You
Right.
have an appraisal and they're not going to do any different or do anything to fix it. So, and that's kind of hard. If you're doing a FHA or VA loan, they have to meet a criteria that the government sets, not the seller and the buyer.
Yeah.
So, yeah.
There's a certain regulatory process that has to take place.
Yeah, exactly. So the VA, they're watching out for veterans who are purchasing these homes. So of course they don't want them to buy a
Crummy
lemon,
home.
a crummy home, or a piece of crap home.
Yeah.
So yeah, that's the reason why there's a lot more intricacies and requirements, like you said, for those loans. Sorry.
No, it's all
hijacked
good.
it.
It's all good.
Yeah.
I asked you a question.
I go on these tangents.
That USDA, there's locations that are and are not eligible for that.
Yeah, yeah.
And then, based on the type of loan, as a realtor, it's a lot easier to guide you through looking at homes and not give you this false expectation of, oh, I'll be able to afford this, or, oh, I'll be able to do that. And so if we don't know what type of loan you're going to go through or what the requirements are, it's a lot harder for us to, help you pick out what you want.
Yeah. I mean, there's a big difference between qualifying for a VA loan and an FHA loan because, just as an example, if I do 0% down on a $300,000 house, my loan size is going to be $300,000. If I do an FHA loan, the purchase price is still $300,000, but I'm gaining equity by putting money down.
Right.
So my payment's going to be less. Right. But the rates are going to be similar. I mean, the rates could be a little bit different, but not by a whole lot. But yeah, there's going to be a difference in what you can afford if you do it that way.
Right.
So yeah, it's a very good point.
And, I think we also wanted to touch on what the mortgage process is.
Yeah. Yeah. So we talked about condition, we talked about location, and the eligibility for that, and the types. So, I would say the big thing is, who doesn't love a flow chart, man? Flow charts are great.
Flow charts.
Reminds me.
Back in elementary school.
Yeah, dude, flow charts in elementary school, and also middle school. All right. So first things first, I'm the realist, but second things second, it starts with, let's say somebody sends, you refer someone to me, right? So let's say you refer John Smith to Will Todd, right? John Smith is going to put in a loan application. After he's completed the loan application, then I'm going to review what I have from him, and I'm going to see what I can get him pre-approved for based upon the loan type, the rate, and his income and his credit score. So all of those things do have an impact on what he's going to qualify for with that pre-approval. Then after he's pre-approved, it really sets the realtor and the buyer up for the best expectation and chance of what they're actually going to be able to afford. So like tangent, and I know we're going to talk about it in a minute, but what would you say, like, what are your thoughts on all these buyers who reach out to you who are like, I know what I want, and they've never gotten a pre-approval. They've never even talked to a loan officer, and they're just looking on Zillow. What are your thoughts?
So it's hit or miss. Some of them have really realistic expectations and the other ones don't. And I think we touched on this last episode with home payment calculators and home value estimators. Those don't really give you a good expectation. They can give you a ballpark. They can really give you a decent ballpark, but there's so many factors at play. People who reach out and they're like, I've never talked with a loan officer. That's fine. I'll get you in touch with a good one.
Sure.
You know what I mean?
Yeah.
But, people who want to go look at houses before they're pre-approved, it's almost a no-no, especially for me, because you're not a serious enough buyer yet where you've taken the steps to go, okay, this is what I can actually afford. This is my exact number. Okay, I can bring you up to that exact number. If we find something lower, great. We found you a better deal, right? But people who want to look at houses before they're pre-approved, or they're just all go, I'll get pre-approved later.
Yep.
You can't, most sellers don't take buyers' offers without pre-approval letters very seriously at all, because it's sort of like a coin flip. Are you going to be able to afford this house, or are you not? So that pre-approval just gives me, it gives the seller, it gives the buyer confidence that they can actually afford that home.
Yeah, no, 100%. I think we've talked about it many times. I think, so many people go into buying a house with unrealistic expectations. And I think we talked about it last episode specifically. Somebody wants to buy a house, they have no idea what they qualify for, and they're expecting to be able to have the pool, to have 4 bedrooms, 3 baths, and have 2,500 square feet. And it's like, hey, here's reality. You make $70,000 a year. You're not married. You qualify for $275,000.
Right.
That's not even being mean. Rates are high, so you qualify for less. Housing prices are high, so you qualify for less inventory. So you're not going to meet all of the expectations you want, but that's where we have to make sure people have a reality check. And that's what the pre-approval helps with. It's not just reality check. It's giving them the actual reality of, this is exactly what you could buy if we do this, or if you agree to do this loan. So yeah.
And that's why I think the buyer exercise of write down your 5 needs and write down your 5 wants. Let's find your needs, and if we can score your wants, even better. Mm-hmm. But, the needs are what is more important. And if you're pre-approved for a smaller amount than you initially anticipated being pre-approved for, you may have to sacrifice on some of those wants. Mm-hmm. But you want to make sure you meet your needs. And those needs are, how many bedrooms do you actually need? How many people are in the house?
Yep.
Where do you need to be in terms of commute and location?
Yep.
That can very much dictate. Sometimes you're going to have to sacrifice on bedrooms if you need to be close to work. And sometimes you're going to sacrifice on commute if you need a certain number of bedrooms, especially around Charleston.
Yeah, I think that's exactly perfect explanation. But I mean, we're going to talk about it more. I'm sorry we went on a tangent, but
no, it's all good.
Following the flow chart. So you go on the home search with a realtor, Walker, possibly. You put in an offer on a house. Let's say the seller accepts the offer. Yippee. And make sure you don't forget about getting seller concessions. Always try, in my opinion.
I'm sure we'll talk about that here in just a second.
Yes. Processing and underwriting. So after you get that offer put in, then we're going to get the contract. For instance, I'll receive the contract, or my loan processor will receive the contract. We will upload that. Then we'll start getting everything together, all the documents, the income information, all of the fun stuff that I know makes the mortgage process somewhat daunting for a lot of people. Right. Tax returns and all these other things, pay stubs, and having to deal with your HR department, who doesn't love going to HR. And then after we get through all of that, we get you clear to close. And once we get you clear to close, we set the closing date prior to clear to close. But we get clear to close, and then we close. You get the keys to the house. Everybody's happy.
And now you're a homeowner.
So, there you go. That's the gist of the flow chart. I mean, there's a lot more behind the scenes steps that go in that processing and underwriting piece that Walker doesn't get to see, but myself and loan processors get to experience, and it can be stressful. So,
just the little bits of, we need this done right now.
Yes.
Right now. And
yes.
It's like,
there's no chill sometimes.
No chill.
So yeah, it can definitely be fun. All right. So closing costs and your mortgage. So
that 3.5 down payment.
Yep.
It's not all that you have. You have other costs associated with buying a home, origination fees, those escrow accounts, the attorney fees.
Yep.
Those can all make up a significant portion of what you pay, a couple grand even.
Yeah, I mean, it can be more than that. I mean, the big thing is when you have, let's say you have 3% down for a $300,000 house, it's $9,000. That's great. Good job.
Right.
Cool. You got to cover closing costs. It's going to be origination fee. It's going to be whatever is included in your closing costs, which is going to include the closing settlement fee, title search, all of the other fun stuff. If you have, you're going to have to pay for your taxes, how we do it here and what's required by law, or not required, but the maximum that can be. And we do this just to make sure everybody's safe. With escrow, we usually collect 2 months, so 1/6 of the year's total taxes and insurance. And if there's HOA dues, then we'll just tack that in there as 1 or 2 months usually for the HOA. So we do 2 months. We collect that up front. That's included in your closing costs. In addition to any origination fees. If you're buying down points, that would be something that could be, that's why it might be higher.
Right.
If I want a 6% rate, you can get a 6% rate right now. You're going to pay $15,000.
Right.
You can get a 6.5% rate. You might pay $1,000. So all of these different things do matter. And they do add up, and it can be as little as a couple $1,000 to sometimes, if it's a really high priced loan, it could be 3%, it could be 4% of the loan size. So,
right.
Or purchase price. So that's a big difference. So you really want to be safe. I would save, if I was counting it based upon purchase price, 6% is what I want to have saved compared to a $300,000 house.
Right. And that falls kind of in the middle of that estimated range we have there, that between 2 and 5% of the purchase price is dedicated purely to your closing costs on top of your down payment.
Exactly. There's something to be said, and this is, I don't know if you guys are keeping up with the market. The inventory is very high. Prices are still very high, but the inventory of houses on the market is pretty high.
It's rising.
It is rising, and same with listing days on market. Days on market. Yeah. Houses are sitting for longer. So instead of going with a builder who's going to give you incentives, and those things are great, and they might give you a really great rate, but you can get seller concessions.
Right.
For a conventional loan, you can get 3% seller concessions or seller credits to help pay off or pay some of those closing costs.
Right.
For FHA, this is a big one, 6%. You can get up to 6% seller credits.
Right.
Which is insane.
It is.
You could cover everything.
You could cover all your closing costs and then some.
Yeah. You could do
just what the seller's willing to give you to sell the house, because it's been sitting there for 6 months. They're sick of it. They want to get rid of it.
You could get, you could do a temporary rate buy down. You could buy down your rate permanently, with borrower we're working with now, bought down rate and temporary rate buy down.
Right.
So overall winning, right? He's going to be paying, a 5%, 5.5%, or 5.25% rate for the first year.
Right.
Which is going to save him like $100 or $150 a month. So,
which over a year is crazy amount of money, especially if it's just paid by the seller when you buy the home.
Yeah.
Because they're ready to get rid of it. They have other plans that they're trying to do. Mm-hmm. Those D's, the diamonds, divorces, diapers, deaths, all those things that cause people to have to move now.
Mm-hmm. Yeah. I mean, right now, I think we're going to see an increase this summer.
Right.
Of people coming out to buy, but their rates are still a bit high, so it's a bit hard. But even with that, you can still get a great deal on a house that's been sitting for 3 months.
It's been sitting over the winter, and they had almost no showings over the winter because nobody wants to buy in the holidays.
Yeah.
So they're ready to move.
Yeah. So overall, I think another thing, if we can go back to the slide real quick, on here, we talked about this, off camera, but attorney fees, there are things that you guys need to be aware of. You can shop around for attorneys and seeing who's going to give you the best price, who's going to perform the best. And you can pay a buttload in attorney fees if you work with somebody that's really charging you too much. And I think the big thing is you want to find somebody an attorney that somebody recommends. You and I can recommend an attorney.
Right.
And I think the big thing is you have to remember that you can shop around to find what the best deal is.
Right.
And you, as a consumer and as a borrower, if you're buying a house, you should find the best deal and also find somebody who's also does a good job.
Right.
So that could save you on closing costs. And that's something that you guys should be aware of is how important it is to take advantage of the rights you have as a consumer to be able to shop around for those closing costs.
Just like you would shop around online for finding something that's on sale.
Exactly. Yeah. So that's so important. I think one of the things on here, it says your strategy for relief. What would that be? Like seller concessions?
Seller concessions is a good bit of it, shopping around attorneys, different various insurance. I know you can shop around for, and certain lenders, if you're trying to find different lenders have different origination fees and they have different various costs that they include in their closing costs. You can shop around at the different lenders. I know you work with how many?
We have about 20 lenders that we work with.
Right. And I'm sure those 20 lenders have very different closing costs.
Yeah. So, I could pull up, John Smith, who's buying a $300,000 house. Let's say he has a 700 credit score. I have a list of 20 lenders that I can go to and say, okay, right. This lender has the best rate and it doesn't charge them that much. It actually, let's say these are some other terms that we're going to talk about later. The par rate, which means you're not paying for, paying a rebate, which would mean you're paying to get the rate lower and you're not receiving anything back. Basically you're paying $0 to get this rate. Let's say the rate is 6.25 at one place and you don't pay anything. And then if I want to get 6.25 at another lender, it costs me $500.
Right.
Okay. What do I have the ability to do that banks don't?
I go with the lender that doesn't charge you that $500.
Yeah. So that's the key is as a broker, we can actually give you the best rate and we can get it to you the cheapest
and cut down on those closing costs that can just add to your what you have to pay at close.
Yeah, and another thing too that I didn't say, Walker, is I don't know if you're aware, you can with getting a rate, you could get a higher rate and then actually get a discount, right?
Right.
That can go towards your closing costs. So same example, I have John Smith, okay? So John Smith, he doesn't have much money for closing costs. You negotiate a great seller concession for 3% of the purchase price,
right.
But he's short $2,000, right? But he could still qualify for the loan at 7%. Then a suggestion and the ethical thing to do would be, hey, John, at 7%, you're going to get $3,000 in a discount to take this rate, and that can go towards your closing costs, and you don't have to pay anything. That's an option that can be utilized for people who don't have a lot for a down payment.
Right.
So that's something that...
There's a lot of financial workarounds that you can use and programs that you can use to just par down your closing costs, decrease the amount of money, and get you into the position where you can start building equity on a home.
Yeah, exactly. I mean, there's so many intricate details that I could go on 37 tangents as I already have. But, these things are important, guys.
I know we've talked a little bit about that pre-approval power play as it's coined,
As you've coined.
I've coined it.
Yes.
That pre-approval, it's that green light, to start actually seriously looking at a house, and without it, you're, playing that guessing game that will end up leaving you disappointed or wanting more really in your house because you went and looked at houses that were way outside your budget and now you've got a taste for the good stuff.
Yeah.
It's hard to come back down to what's realistic.
Yeah. I think just the reality is Zillow's great. It's great to look at things, but
great window shopping.
It's great window shopping, but it also gives a lot of people a false impression of what they can afford. When let's say I go on Zillow right now, if I go on there and I don't have an account, it's going to show me, the payment is X amount. And, let's say the payment is $1,500 a month.
Right.
Okay. Based off of what? If I have a perfect credit score and I put 20% down. Okay.
That's not a lot of people.
It's not helpful. It's a lot. I mean, it's giving people not false hope, but it's giving them
setting an incorrect impression of what is realistic.
It's not making it realistic for somebody who's in their 20s or 30s making $70,000-$80,000 a year, and they're looking at $550,000 houses, and really they can qualify for $325,000. Don't quote me on that. I'm just saying, like, they can't qualify for that. That's
right.
Just it's not fair to them. That's why pre-approval is such a powerful thing. Is you can be sure,
you can really know your budget
of, okay, Mr. Realtor,
right?
This is what I've been pre-approved for. What can we find in this price range that I like?
Right.
So that's so important. And you talked about it earlier. It helps you become a serious buyer. Like you said, it's so important if you're going to put an offer in to be able to have the pre-approval and say, okay, seller, this is what I have. This is what I'm pre-approved for. And this is what you're asking. And
right.
I'm willing to pay it.
Right.
Or I'm willing to pay it minus whatever that
negotiation is.
Yeah. And it's helpful for me as a loan officer to be able to get you to closing more quickly. If you get me all the documents that I need, unlike some borrowers that we're working with, no names. So, that is so helpful for me up front. If we can get you pre-approved and you help me by providing documents, that gives us a leg up to be ready to close and be maybe even ready 10 days, 2 weeks ahead of time.
Right.
So,
and then you can move it closing up, or you can just wait. I mean, you have breathing room essentially. Yeah. That pre-approval really gives you the grounds to, spot those credit issues early, get to that faster closing, having all that paperwork up front.
Yep.
And it really, the pre-approval gives me the green light to actually go and show you houses. Because
yes, exactly.
Otherwise it's
a guessing game.
It's a guessing game. There's really no other way to put it.
Yeah. So you hit on there a second ago about spotting credit issues early. So the reason why that's helpful is if I have a borrower, Mrs. Smith, she's looking to buy a house and she wants to get pre-approved. And I pull her credit and it comes back at, let's say, a 575, okay? If she has a 575, she doesn't qualify for an FHA loan unless she puts 10% down. Right. But what I have at my disposal is I can actually help with credit repair. I can find out, okay, what's going to get us to 580 or what's going to get us to 600 or 620, whatever credit score we're trying to shoot for to qualify for a program. We can do that. We can actually know, okay, hey Walker, you're a borrower, we're working on some things, got to get some things, situated before we can get a pre-approval out.
Right.
Then it sets their expectations not to cut their feet out, but it actually helps them prepare for, to be a serious buyer so they can get that pre-approval.
Helps them afford more house even.
Well, yeah. I mean, if I have to put 10% down compared to 3.5%, geez, that's a huge difference. It's a huge difference.
Massive difference.
All right.
The offer and mortgage contingencies. I know. Bunch of legalese in here.
Yes, we love we love legalese. Sorry, the Don was coming out of me.
No, it's all good. It's all good. That. But the purchase offer isn't totally just about price, even though that's the big number everybody wants to worry about. But there is things built into the contract to protect you in case that financing does fall through.
Yep.
That mortgage contingency, we have an appraisal contingency, we have a mortgage contingencies, we have contingencies for termites, because a lot of times mortgages will fall through under all of those contingencies. A property won't appraise, meaning the value of the home is not up to the offer. It was overvalued on the MLS. And so now the financing's falling through. You can cancel the contract, say, hey, we need to revisit. This home's not right for us. that's CL 100, which is a termite inspection in South Carolina. It's required for all financing pretty much. And, if that CL 100 falls through, it shows, and the financing goes, wait, we can't finance a home that has all these issues. You can cancel the contract. You're protected. There's a lot of buyer protections built into our documents that I'm sure you have the same buyer protections built into a lot of your documents as well.
Yeah, it's a very highly regulated industry. Real estate is in general. But I mean, the contingencies are important for you to be protected. Let's say, for instance, like you said, let's say it fails something. Let's say it fails. Let me think.
Proof of funds fail.
Yeah, proof of funds fail. Let's say the home won't appraise, or some other issues. Okay, well then, if I've put $1,500 down as earnest money, maybe I can get that returned if it fails.
Especially under that mortgage contingency. That is a part of the mortgage contingency, is you receive the escrow money back. Yep. You're not losing money because it was up in the air and you didn't have a real reason. It is a stone in the sand. This is an actual reason you can pull out of the contract with minimal repercussions.
Yep. So, like, for instance, when I think of contingencies, I think of a lot of like conditions to close. So like, it could be based off of, hey, I need to have, 2 bank statements for, let's say I have a money market savings account and I have to have two months of bank statements that are accurate. Those things are important in order to get the the clear to close and everything else. If I don't have proof of funds, like you were talking about, or proof of financing, then I'm up a creek without a paddle.
Exactly.
So, and we're dealing with some fun situations where, if you don't have the things sorted out, it can really put a kibosh on the whole deal and make you have to change the closing date and all of these other things. So it's so important that you're aware of what we're looking for when we say, hey, we need a proof of a deposit or something. These things are very essential, and it can kill a deal very quickly if you don't.
It can.
So, because the seller might get really frustrated and
especially
say, hey,
if you push a closing out 2 weeks because you didn't have your ducks in a row.
Yep, exactly.
And then if that happens and you need to cancel the contract, those contingencies are in place so that you have the minimal amount of repercussions. You're not losing a ton of money. You're just really losing time is the big deal.
Yeah. I mean, I'm just glad we had enough time for this one we're working on.
Right.
I think the fun thing is, sometimes borrowers don't do the things you ask them to do, and that's life. But, anyways.
Yeah. Fun stories.
What is going on?
I don't know.
All right. So,
loan officer realtor communication.
Yes. So, what would you say is the benefit of a loan officer and a realtor having, I guess, a relationship, friendship, prior to doing a transaction together?
It really just puts them on the same page. Because if, let's say, for example, you go with your personal bank, which is always a good recommendation. It's always good to check with your personal bank. People that they may be able to give you some incentive that you wouldn't be able to get with a broker.
Yep.
But, that information flow, like I have written here, with your permission, of course, because nothing's going to be disclosed between us behind your back that you don't know about.
Yeah, financial information is not allowed to be given out to the realtor. Credit scores, all these other things. I cannot share those things with a realtor. It is illegal for me to do that. That's why I have my license. It's a very, very regulated thing, and it's important that both he and I have a clear distinction of these things.
Right. We have 2 separate jobs. We're not the same person.
Yes.
But staying on schedule, whether that's proactively solving problems, things that come up and they're a hiccup. And, sometimes we can resolve those things behind the scenes. You don't even need to be involved.
Yeah.
But you'll know about it because it was an issue and it came up and you'll know about it. But sometimes that can be pre-resolved. And it doesn't take much effort on your part where you have to you have to be the middleman between 2 people
Yeah, I think it's, I've had some great experiences with realtors who have been really just great communicators. I've also had some really tough, communicating realtors who just have not communicated well, and I've had to basically beg the borrower to do the communicating. And it's so important to have the two-way dialogue. Otherwise, it's going to be like prying teeth. Not prying teeth, pulling teeth.
Pulling teeth, yeah.
So like I said, it's the proactive problem solving, the unified goal of home ownership. We're trying to get you into the home, me as the loan officer, he is the realtor. And then we also offer the clear buyer guidance and communication. So we're trying to help you, and we're trying to do what's in your best interest. So if it means, okay, hey, we should pull out of this deal. You should go to a different property because of X, Y, and Z. Then that's going to be communicated by Walker. That's going to be communicated by me as a loan officer. It's dependent. We're going to do what makes sense and is right by you. And if we don't, let us know.
Right. And I'm like contractually obligated. I have to take your best interest in heart.
As am I.
As is you.
Yeah.
We cannot take our own personal interest, whether it be because of commission or because, we have somebody else who wants to buy this property, But, that clear communication, that unified goal, I think is really the big thing. Is if they have some sort of relationship or connection or prior communication, it's a lot easier to pick the ball up and go, all right, we've worked with each other before. Here's what we need to get done. We've already rehearsed this act. We know each other's processes. We know how the other person communicates. It's easier to pick up the ball when there's already some repertoire built up.
Yeah, no, exactly. It just makes it more like I'm working with someone that knows how I work, I know how they work, and we know what the next step is in the process. So, like you said, the information flow and making sure we're caring for people, then staying on schedule, it is our responsibility to make sure we close on time. It is our responsibility to make sure that all of these things are met to the right standard. And, sometimes things don't work out. Sometimes it's things out of our hands directly. And that's not fun, but, we try to communicate that as soon as we find out about it.
Right.
And then, like you said, we are doing what's in your best interest. We are your advocate in this transaction. He is the advocate in negotiating the contract.
Right.
I am your advocate in getting you the best financing deal you can.
Right. Property and loan, two different worlds, but when two people can come together and sort of mesh the best of both worlds, you can get into a really great house for not as much as you thought originally.
Yeah, absolutely, man. Well, cool. I think that was the last thing we got, and I think the big thing is on this one, I think we're going to have some banners up above us or below us. If you guys have questions, we have more to come about these topics. We're going to go more in the weeds, but also going to see if there's any questions in the comments. Please don't forget to like, subscribe, and comment below. We would love to have some engagement and see if we can answer questions. My name is Will Todd. I work at Lifetree Lending here in Mount Pleasant, South Carolina. My NMLS number is below. Walker?
I'm Walker Blue. Work with Carolina One Real Estate underneath the Blue team. Over there on a good old IOP, Isle of Palms.
Isle of Palms.
And I think we're going to start a couple mini series coming soon. Breaking down these big words, these interest, amortization, all these things. Little 6-10 minute videos that really go in depth on these topics so that you are the most informed you can be, especially going into your home purchase.
Yeah.
And if you want to get in touch with us, info@palmettopropertytalk.com, and visit the website, check us out.
Yeah. Awesome, guys. Well, hey, hope you guys have a great week. And if you have questions, don't forget to comment, and we will get to you as soon as we can.
Yes, sir. All right. Have a good one, y'all.